Have you ever wondered whether your so-called diversified index fund is actually diversified anymore? Because lately when I look at the stock market, something feels strange. Millions of people believe they are safely invested in hundreds of companies through the S&P 500. They believe their retirement accounts are spread across the entire economy. Technology, healthcare, consumer goods, energy, banking, everything. But when I started digging into the numbers, I realized something shocking. A tiny handful of mega-cap companies now dominate the entire index. In fact, the largest companies now make up more than half of the S&P 500's total weight. That means the market most Americans trust for diversification might actually behave like only 5 or 6 giant stocks wearing a trench coat pretending to be an index. And when I realized that, I started asking a very uncomfortable question. What happens to your 401k if just one of those giants has a bad quarter? Because if the largest companies stumble, the ripple effect could spread across the entire market instantly. Today, I want to explain something called concentration risk, why diversification is becoming harder than ever, and why the stock market of 2026 may be far more fragile than it appears. Before I jump into the explanation, make sure you subscribe to Dave Invests Smart, because on this channel I try to break down the deeper forces shaping markets so we can understand what is really happening with our investments instead of just watching headlines. Let me start with a simple concept most investors learn early in their financial journey: diversification. The basic idea is that spreading your money across many different companies reduces risk. If one company performs badly, the others can offset the loss. That is why index funds became so popular. Instead of trying to pick winning stocks, you simply buy the entire market. For decades, the S&P 500 represented exactly that. 500 companies from different industries representing the broad American economy. Technology firms, industrial companies, healthcare giants, retailers, banks, energy producers, and many others. But over the past decade, something dramatic has changed. A handful of mega-cap companies have grown so large that they now dominate the entire index. Think about companies like Apple, Microsoft, NVDA, Amazon, Alphabet, and Meta. These companies are not just successful businesses anymore. They are economic giants, with market values larger than the GDP of many countries. And because the S&P 500 is weighted by market capitalization, the biggest companies automatically receive the largest influence inside the index. That means when these giants rise, the entire market rises with them. But when they fall, the entire market can fall too. When I looked at the numbers, I realized that the top handful of companies now account for an enormous share of the index's movement. In other words, the S&P 500 may technically contain 500 companies, but its performance is heavily driven by a small group at the top. This is what investors call concentration risk. And it becomes even more interesting when you look at something called the overcrowding effect. Overcrowding happens when investors collectively pile into the same companies because they appear to be the safest or most profitable choices. Over time, these companies become so popular that they dominate portfolios everywhere. Institutional investors buy them. Mutual funds buy them. Pension funds buy them. Retail investors buy them. Index funds buy them automatically because of their large market capitalization. And suddenly the entire financial system becomes dependent on a small group of stocks continuing to perform well. Now here is where things become even more fascinating. When I study market structure in 2026, I notice something that looks like a pattern. Many sectors now seem to revolve around a single, dominant company. In semiconductors, NVIDIA has become the defining stock of the entire industry. When investors think about the future of artificial intelligence chips, they think about NVIDIA first. In healthcare, companies like Eli Lilly have become dominant forces because of blockbuster drugs and massive growth expectations. In cloud computing, Microsoft and Amazon dominate. In consumer technology, Apple remains the center of gravity. And in digital advertising, companies like Alphabet and Meta control huge portions of the online ecosystem. This phenomenon is sometimes described as the one dominant stock per sector effect. Instead of dozens of companies sharing leadership, each industry ends up with one superstar company capturing the majority of investor attention and capital. When I step back and look at this pattern, I realize something important. Diversification becomes much harder when entire sectors are represented by a single giant. Imagine you believe you are diversifying by investing across technology, healthcare, and communication services. But if each of those sectors is dominated by one company, then your portfolio may still depend on just a few corporate earnings reports. For example, if NVIDIA releases a disappointing earnings report, the entire semiconductor sector can fall. If Eli Lilly struggles with drug approvals, the healthcare sector may react. If Apple reports slowing iPhone sales, technology stocks might weaken. And because these companies carry enormous weight inside index funds, the ripple effects travel directly into millions of retirement accounts. This is the hidden reality of modern index investing. Your diversification might be narrower than you think. Now I want to be very clear about something. This does not mean the S&P 500 is broken, or that index investing suddenly became a bad strategy. Index funds remain one of the most powerful tools for long-term investors because they provide broad exposure to economic growth with relatively low costs. But understanding concentration risk helps explain why markets sometimes move in surprisingly dramatic ways. When a few companies dominate the index, even small changes in their performance can influence the entire market. And we have already seen examples of this. When NVIDIA's stock surged because of the artificial intelligence boom, it lifted the entire market higher. Technology indexes rallied. Index funds gained value. Retirement accounts benefited. But imagine the opposite scenario. What happens if expectations become too high? Because that is another interesting feature of mega-cap dominance. The bigger a company becomes, the more perfection the market expects. Investors are not just hoping these companies succeed. They expect them to deliver extraordinary growth quarter after quarter. When expectations reach those levels, even a small disappointment can trigger large stock movements. A company might still be profitable. It might still be growing. But if growth slows slightly, the market reaction can be severe. And because the largest companies now influence the entire index, those reactions spread across the market. That is why concentration risk becomes so important to understand in 2026. The market may look broad, but its behavior is increasingly driven by a small group of dominant companies. Another interesting effect of this concentration involves investor psychology. When a few companies lead the market, investors naturally want to own those winners. No one wants to miss the next NVIDIA or the next Apple. So more money flows into those same companies. Index funds allocate more capital to them automatically. Active managers buy them to avoid underperforming benchmarks. Retail investors chase them because they see them dominating headlines. And the cycle reinforces itself. This feedback loop is exactly what creates overcrowding. Everyone owns the same stocks. Everyone depends on the same growth stories. And the entire market narrative becomes tied to a handful of companies continuing to dominate their industries. But history teaches us something interesting about dominant companies. Even the strongest market leaders eventually face competition disruption or slowing growth. The largest companies of one decade are not always the leaders of the next. Think about the corporate giants that dominated the market decades ago. Many of them still exist, but they no longer control the same influence they once had. Innovation shifts industries. New technologies appear. Consumer preferences change. And new companies rise to replace older leaders. This cycle is one of the reasons markets remain dynamic over long periods. But during the transition period's volatility often increases because investors must adjust to changing leadership. And that is why concentration risk deserves attention right now. When the market depends heavily on a small number of companies, the transition from one leadership group to another can create powerful market swings. If those dominant companies continue delivering strong earnings, the market may keep rising. But if leadership begins shifting toward new industries or new companies, the index structure may need time to adjust. During that adjustment period, diversification becomes more complicated, because the traditional index weighting system automatically favors yesterday's winners. That does not mean the S&P 500 will suddenly collapse. But it does mean investors should understand what they actually own. When you invest in the index, you are not just investing in 500 equal companies. You are investing in a market where a few giants exert enormous influence. And those giants represent the cutting edge of the modern economy. Artificial intelligence, cloud computing, biotechnology, digital advertising, and global consumer technology. These sectors are shaping the future of economic growth. But they also concentrate market power in a way we have rarely seen before. So the next time you hear someone say the S&P 500 is perfectly diversified, I want you to remember the trenchcoat analogy. Yes, the index contains hundreds of companies. But underneath that trenchcoat, a few mega-cap giants are doing most of the walking. And understanding that reality helps us think more clearly about risk, opportunity, and the future direction of the market. Because the truth about investing is that the most important risks are often the ones hiding in plain sight. If you found this explanation helpful, subscribe to Dave Invests Smart, because my goal with this channel is simple. I want to help you understand the deeper mechanics of markets so you can make smarter investment decisions while everyone else is just reacting to headlines.